Good evening. Good evening, Wim. Good evening to all of you in this room and also watching us via YouTube. I'm Veronica Vera. I am one of the investor relations of Cobas Asset Management, and I'm in charge of the French market, the Belgium and the Luxembourg market. I'm sorry, my English is not very good and my Spanish is not good, but it's not me that you are listening to, and you will be free to raise your question in average English. Everything is fine. So, as you know, one of the Value School objectives is to promote education and dialogue among the investment community, sharing knowledge and helping people becoming more rational, independent, and long-term value investors, and providing investors with a wide array of investment options. Tonight, we are very proud to welcome Wim Antoons. Wim Antoons is head of the asset management at Bank Nagelmakers in Belgium. Wim has 22 years experience, and especially in the value investment strategies. Zooming on the purpose of the day, Wim will share one of his masterpieces of work on a very crucial point: the asset allocation decisions, and particularly those involving market timing, create both opportunities and risks. By market timing, we talk about the process of trying to predict the future direction of the market and switching between asset classes and cash in order to benefit from changes in the market. Wim, I leave you the floor.
Thank you, Veronica. Thank you for hosting me on this conference. The article has been written about 1 year ago, and I wrote it for the Brandes Institute, which is more or less similar to what your people do here. It's sharing academic research. And that's the purpose of tonight. We are just going to share some academic research about market timing. I started with presentation with a very beautiful quote of Benjamin Graham, who once said, I'm not going to use the same wording, but he said that your worst enemy is most likely the man in the mirror. And when we're talking about market timing, what we're going to see that is more or less the same. So people try to time the market, but eventually they lose up a lot of money by trying to do so. The agenda for today, we have 4 major points we're going to talk about. The first, of course, is the wording, the definition. What do we understand about market timing? What is it? Then we're going to talk about the risks and opportunities. There are a lot of risks, but there are also a lot of opportunities if you want to time the market. So we're going to discuss that. Then very important is the evidence. Some people say to me they can do it. I've tried to look for some evidence to see whether we could find some people that can time the market. And so I'm just going to share some examples, 5 or 6 examples, to see whether we could find some people that in a consistent manner could time the market. And then, of course, we are just going to conclude. So the definition for tonight, it all starts with a strategic asset allocation. You're all professionals. I know you know what it is. If you're sitting in front of a client and try to complete this MiFID profile, being 50%, yeah, it's a dirty word, I know, being 50% fixed income or 50% equities, but that's your strategic goal, and I think that's the most important decision to make with a client. And then, of course, every month you must have these committees and you discuss whether you need to invest a little bit more in fixed income, or you need to go to real estate, or you need to increase your position in value stocks. So you do some tactical overlay to try to have a better performance. But then when it comes to market timing, it's just a special form of tactical asset allocation. So we refer to the fact that you move in and out cash or in and out an asset class. That's a special definition. We don't talk about, because market timing is also used in terms of funds, when you try to time funds, when you can go to a fund before the market close. But that's not what we are talking about. We are talking about moving in and out towards cash. I start my piece of research with, it's a quite all the research has been done in 1986, but the authors were trying to figure out what is the determine the variance in your portfolio. What is the most important determination of volatility in your portfolio? And what they found is that 94% of the volatility in your portfolio is determined by your strategic asset allocation. So it's not by all the rest. If you look at it, security selection only counts for 4%. If you look at market timing, it's only counting for 2%. And of course, there is some unexplained. But the most important decision is the strategic weight that you give to your portfolio. We also found, because I looked at the number of portfolios that really played on market timing, what we found is that the variance is even bigger than without doing it. So the main reason why people try to do is just to lower volatility, to lower drawdowns, and what we found is that just the opposite. So that's the reason why I wanted to start with this beautiful graph, to say that the most important client meeting you have is the first one, because there you determine what the end result will be. In terms of risks and opportunities, we all know, yeah, there is of course an opportunity, and the opportunity for everybody who's tried to time the market is just to avoid these years like 2008, you know, when everything comes down and people just want to avoid that. That's the main discussion we have about market timing. But there are a number of risks, and the first that's always going to be, if you are in cash and the market starts to rally like it did in March 2009, you're sitting on a pile of cash, and what are you going to do? You wait, and when are you coming back? Is it by the end of 2009? Is it in 2010? So it's just missing part of the bull market is a very high risk. Of course, if you increase turnover rate in your portfolio, then you also increase your taxes and your costs. So you need to overcome that. If you do market timing, that's one thing you face. It's very important. And then you have these false trading signals. I remember in summer in 2011, the market corrected quite severely, and I was just in a holiday in Spain, and I received some telephone calls from my work saying, what are we going to do? And I said, I don't know what you're going to do, but I'm sitting on a terrace having a beer. What's the problem? Well, the market is crashing. And I said, well, you can buy more stocks at a cheaper price. But it was not the answer that they're willing to have. So you can have these false trading signals, and you try to play on it, and you will see it, and you can also lose even more money. So the opportunity, I'm just using a live example, and I just selected 4 asset classes going back from 1926 to the end of 2016. And I took the performance of cash, and I took a proxy, T-bills, 30 days. I took a proxy for bonds, which are long-term government bonds, and I took a very long duration, 20 years. We took a proxy for equities, which is the S&P 500. And then we took, of course, the best asset class. And here you can see the result of $1 invested in the different asset classes. So cash hardly made money, but it's not a surprise. If you just invested $1 in cash, it delivered you $20 at the end of the day, or at the end of this period. So I also put inflation there, so you can see that you hardly can beat inflation by investing in cash. And not surprisingly, if you invest into bonds, the result is a little bit better, but it's only 135. So it's not good long-term investments, and we all know that. And I took even bonds of 20 years with a very long maturity. So it's not the best asset class to be invested. And we all know that stocks are much better. If you put your money into the S&P 500, you would end up having an end capital just over $6,000. But look at the best asset class. If you would have invested at the beginning of each year only one trade into the best asset class every year, you would end up with a capital over $4 million. So there is a large opportunity in doing so, just by avoiding big crashes. Now, I start here just giving you the performance of the S&P 500 from 1961. So the entire presentation starts normally at 161 to the end of 2015. And just to buy and hold in the S&P 500 would deliver you a nice capital is the blue line. But if you miss some days, then the results are quite different. If you miss the best days in the market, it's only the 25 best days. It's in a period of 56 years, which is quite long, and you missed the best days, then you see the result is quite lower. It's a huge difference. But you can turn it upside down, and there's the opportunity. If you miss the worst days, your end capital will be much higher. That's a green line. And then if you miss both, the best and the worst, then you would end up a little bit beyond a buy and hold approach. Now, let's look a little bit at the figures because it's much more clear. So a buy and hold investor in the S&P would have made about 10% per annum, which is a very nice, decent return. But what you can see, if you miss the best days, your end capital is decimated. Only 25 days make a very huge difference in terms of end capital, in terms of return that you have. It's only 5.8%. But if you miss the worst days, suppose you're a perfect market timing and you could do that, you could end up with a capital which is much higher. It's about 24,000, and your return will be in line with 15% per annum, which is very great. But what I will say is, if you miss the worst, probably you also will miss the best, and I will show that in the next slide, and then you will end up with a capital which is a little bit beyond, but not much. It's 11% per annum. Now, this is a very ugly table, but I will try to explain what I've done here. It's the same period, 61, 2016. On the left, you have the worst trading days of this entire period. On the right, you have the best. And when you see the colors, these are the periods, the days that are clusters. So, for example, the blue color represents the most volatile days in the 2000-2001 crash period. If you look at the green days, this is the period of 2008. And so the white cells are just out of the blue. They just appeared. There is no connection to other days. But look at the green. There is a lot of volatility, as we know, going on in 2008. And not surprisingly, we see a lot of days on this period because we know that 2008 was very bad. But it might be a surprise. We see also a lot of these days on the right, on the best trading days. And it's something we don't remember, but look at this. We have a lot of days in 2008. The market was very volatile, so it went up also between +6 and +10% in this very bad year. So that's why I wanted to say that these days tend to cluster. If you have worse days, high volatility, then there is always a rebound in the market, and then probably it will end up that you also have very good days. If I now put them in another graph, these are the same days, but here the periods are clustered. What you can see that most of these periods of fairly volatile days start with the decline, and decline is represented by red. And then you can see most of the time it starts to decline. And here behavioral finance comes into place. What we see is that the market goes up for a very long period. Then you have volatility. People start to panic. And when the market starts to crash, people start to panic and they sell out. And they miss part of the upside market. This has been very beautiful, shown by Dalbar, and Dalbar is an American think tank, and they publish a lovely study every year about the influence of market timing on investor results. And what they have found in their 2015 paper is that when we talk about underperformance of market timing, that occurs in every market. I was thinking that it only should happen in up markets, but it's not the case. If you look, for example, at October 2008, the S&P lost -16.8%. What we see is that the American average investor lost -24% due to market timing. Now, how is this possible? It's only possible because he sold out in the middle of the month, because he was starting to panic. And if we go back to our table, we can see here that, for example, on the 13th of October, the market rallied 11%. On the 20th, it rallied about 5%. And on the 28th, it rallied again 11%. So the people had sold out. And this is the reason, the main reason why there was an underperformance for the average American investor, about 7%. The same occurred in also very good markets like March 2000. And people were right. The market was very expensive. And some people decided to put some money on the sidelines. So instead of having the return of 10%, they only had 3.7%. So they had a quite severe underperformance of -6%. Now my point is that underperformance by timing the market occurs in every period, in up markets and in down markets. If you look back at this period of 56 years, I was trying to compute how many days would it take to deliver a buy and hold approach. And when people asked Benjamin Graham, what will the stock market do next year? He said, it will fluctuate. And he's right. If you look at the table, what you can see is that we have seen this result, this buy and hold result delivers you 10% per annum, and it's a very long period, 56 years. Now it equals the return of the best 81 days in the market. Only 81 days. All the rest, the market fluctuates, goes up and down. So if you miss these days, then you end up with a capital gain of only 3 basis points, which is nothing. So that's why if you're investing for the long run and you invest your pension money, just stay invested, because most likely what we have seen is that the 81 days occur in periods of very high volatility, when you're more likely to be on the sideline when you perform market timing. I also put the result of the 25 best days. You have seen it. The return already lowers a lot. It goes to 5.9. If you miss the 50 days, then it's only just 3% per annum. So it's very important to be invested in these very good days. The risks in trying to time the markets, as I said, you need to overcome some hurdles, cost and taxes. And I don't know how the situation is in Spain, but in Belgium, taxes always increase, they never decrease. So the challenge is always bigger year after year. The opportunity cost is that you're in cash and that the market starts to rally, and then there is a behavioral aspect. You need to admit that you were wrong, which is of course also difficult. And then you have these false trading signals. It always remembers this quote. I find it a very nice quote of Karel von Clausewitz, once said that the greatest enemy of a good plan is a dream of a perfect plan. And keep that in mind when you try to time the market. Now this is a hypothetical example, but I just wanted to show you the influence of cost and taxes on your long-term return. So suppose you can make in the long run a return of 8% per annum, which is very decent over a number of years. And suppose we are looking at an investment horizon of 20 years. If you turn your portfolio a number of times a year and you face a transaction cost of 1.5%, you lower your return to 6.5%. So the influence on your end capital is that it is 31% lower than you had done anything. So you don't feel it because it's just 1.5%, but in the long run, it really makes a difference. So you can play with this table, you can play around, but anyway, in the long run, what you see that these figures are quite high. So bear that in mind, that even a small percentage of increase in percentage of cost lowers your return dramatically. False trading signals. What this graph shows you is that the decline in the S&P 500 within a year. Now, there are hardly any years where you can see that the S&P never declined. Last year was such a year, but most of the time you can see that in the year you have declines which are quite severe. Now, if you try to play on that, good luck, because you start to panic. As I said in my example in 2011, you start to panic, you sell out, and by the time you have your cash in your account, it starts to rally again. So looking back over the last 100 years, I think we have 2 periods where it really could have made a difference. That was the 29 period, 1929 to 32, when the S&P lost 80%. We had a severe crash, and in 2008, everything was collapsing. S&P lost about 45–50%. Then you could have made money by market timing only when you returned at the right time. But I don't think that anyone had the guts to do so. So that's what I want to say. You have these false trading signals. So there is volatility in the market. Now, the last couple of years, it's very low, but it will come back, and if you play on that, it's very difficult. Now the evidence. I searched for evidence. I have 6 points. Firstly, newsletters. I didn't know that they exist, but in the States you have these newsletters that only give market timing advice. You don't have them in Belgium, but they only say I think the market is oversold, just sell out everything, or it's dirty cheap, just go into the stock market. So we looked at the advisors. We also, and I'm a fund manager, we also looked at the cash level in funds. So are we as professionals, can we predict the market? So we looked at cash levels in fund to see whether we can do it, yes or no. We looked at gurus. You have Hélène Garzarelli's. I took the example in my paper, but you have people that became very famous by doing a good or great market call, but can they do it in a consistent way? So we looked at that. I also looked for rich persons, because if you can do it, some person was become horrible rich by doing that. So we looked at that. We looked at individual investors. Perhaps they are better in predicting the market than we are as professionals. And then we looked at the Dalbar studies, so the difference between investor returns and fund returns. The newsletter, it's a quite old study, and I wasn't lucky because there is no update about it, but it's a great article that has been written in the mid-90s about Graham and Campbell, and they looked at market timing advisors of 237 newsletters in the States. Remember, they only give advice to sell out or to go into the equity market. That's the only thing they do. And they found that 70% of the advices they gave were wrong. So the only people that made money by this were the people who published the newsletters. And then they go a little bit more in detail to say that only 1 out of 3 achieved returns which were above a buy and hold. So these were the good ones, but 2 out of 3 didn't. And then if you look at those who tried to were good in calling bull market or bear market, it's only about 50%. Now you have to remember, I don't have this in the presentation, but there has been some research that has been done that showed that you need to be right in about 75% of your calls to overcome the hurdle of the taxes and the cost. So if you're right in only 50% of the times, you won't make any money. Look at this graph. This is beautiful fund managers. I'm a fund manager. Perhaps some of you are also. So we would expect that we as a group, because it's of course a group of fund managers, not only one fund, that we would lower our cash position to just 0% in March 2009, because the market is very cheap, and that we do the opposite when the market is very expensive. So what we see is that the red line represents the market. Look at the cash level. The cash level is at the highest point in March 2009. So it turns out that fund managers as a group also have behavioral biases, and that they panic, and what they try to do is build up cash during a market correction because they panic, and they are fully invested when everything is rosy. So that's what we see here. We don't find any evidence. I don't speak about specific cases, but we don't find evidence that fund managers as a group can call the market right. The gurus, I'm a member of a website which is called CXO Advisory, and just for $100 or something, you can have a daily article. It's a very nice website. It gives you a 3 or 4 pager about an article, and you can read it. If you like it, read the article. If you don't, you just don't read it. But they also publish guru advice, and they have a large number of gurus that they follow, and they publish the advices. And it's a bit outdated. It's now December 2012, but they had about 6,800 predictions then by people who were calling the market. And as you can see, the number of people that were right were just under 50%, and it's quite regular. The only thing when they started, it just moved a little bit above 70%, but there were only a number of advisors. But as the number increased, you can see that they are just under 50% as a group. The highest percentage in the study is about 68%, which is not enough to overcome your costs and taxes. But it's better, of course, than the group, but it's not enough to do so. Then I try to screen, perhaps you can help me if you know somebody who became rich by this, just drop me an email. I looked at a number of investment philosophies. I like to read about investment philosophies. For example, I admire Carl Icahn. He has a completely different investment philosophy than we do have, but it's a guy that on the board of Apple is going to yell to say, do something with your cash. It's an activist approach. And yeah, it's a lovely approach. It's different from what I'm doing and probably you're doing. But he made a lot of money by doing so. So that's an investment philosophy that works very well. In terms of the disciples of Benjamin Graham, the most famous is Warren Buffett, but we have Paco here in the neighborhood. So we know that these people made a good fortune by following this wonderful investment philosophy. Also admire, for example, John Templeton. He had a different approach. He made these macro calls. So he called the Japanese bull market in the beginning of the 80s. He made tremendous money by doing that. There are some wonderful hedge fund managers there. I just named one, Julian Robertson. I've just lately heard that still his money is being managed. He followed the value approach. But there are some guys that made good money over there. And then you have so many CEOs that run wonderful companies. I just gave the example of Bill Gates, but there are so many CEOs that have a wonderful approach. But I've never found anybody who made his fortune by timing the market. So I just screened for it. I didn't find it. So as I said, if you find somebody, just let me know. Fund flows. The individual investors, what are they doing? This graph represents two things. First, the return in the market, which is represented by the green line. And surprisingly, you see the volatility in the market. And then the blue bars represent the in and outflows. And which a little bit sad about this graph is that it starts, because I updated it, it starts at 2001. Because the previous starts at 2000, and believe me, the blue bars were so high that you hardly could figure it on the graph. So they were very, very high. But not surprisingly, the outflows, the biggest outflows occur in 2008. Just at the bottom of the market, everybody was selling out. And here you can see that people just didn't came back. It lasted a long time before people came back. But people only invest their money when the market rallies. So it's very important to remember that also individual investors just follow the crowd. They follow the performance of the market, and they don't look at the valuation to see whether they should invest yes or no. And then the last study is something I really recommend to order every year. It's a Dalbar study. It's an American think tank, as I said, and they try to investigate every year what the influence is of market timing on the result of American investors. And they look at a number of periods. They started the study 30 years ago, so they're very long figures. They look at it on an annual basis, 5, 10 years. This is a 20-year graph. And they find every year the same result, that people underperform by trying to time the market. So let's look at the result of 1998. The S&P made about 80%. The average equity investor by wrong timing ended up having a return of about 7%. So that's a huge difference. You can say it lowers, but the only reason why it lowers is because the return also lowers. So 98 was the end, of course, of the big bull market. That's why returns were higher. In the study, they look beyond that. They also look at the return of fixed income investors. The bad news for fixed income investors is they end up with a return which is lower than inflation by wrong timing. They look at the return of asset allocation funds, and guess what? The return is the same. They end up with a return that is lower than inflation, so just by wrong timing the market. So I think it's time to conclude, and then we're open to questions. The last thing we have to be reminded is that we are in a very low interest rate environment. So I've seen some results, for example, on the South African market. It's in my article that I wrote. When the return on cash was still 6 or 7%, you could have said, I move to cash, I still make some money. But today, if you move to cash, your return is just 0%, even it's not negative. So, of course, inflation is low, but it makes no sense to move to cash. The second thing is, if you look at it, we didn't find any evidence that you can forecast the market all the time. So if you want to build up a sound investment philosophy for yourself and for your clients, it has to make sense that it delivers you return in the long run. And you can have one call which is right, but you have to be right over 20 years. And that's very, very difficult to do so. And be reminded, if you do it in the wrong way, you can wipe out your entire world. And I think at the age of 65, everybody wants to have some money to have a good life. So you don't want to put that into a game of market timing. So I thank you.
So thank you, Wim. I have two things to tell you. So if you know someone very rich by market timing, you can send us an email. And also the presentation will be available in our Value School website. So, and if you need to have more information and you need to have the contact of Wim, feel free to contact us and we will provide you the data, the telephone or email to Wim. I already asked, it's okay.
It's okay. It's okay.
So before I give you the possibility to raise a question, I have a first one. I think it's is the one that always comes when you talk about market timing, is about technical analysis, chart analysis. Some people may use that as a signal for market timing. What do you think?
Yeah, we've seen most people try to do it by using the technical indicators. You have most use is simple moving averages. So they look at SME, they call SME 10 days, 50 days, 200 days, whatever. They try to apply it on indices, and then they try to market by doing that. Now, what we found is there's a lot of research doing that. There is also one piece of research in the article is that sometimes it works, but it doesn't work all the time, and it won't deliver you the results you were hoping to in the long run. And you cannot foresee false trading signals. So if you end up by doing that, you will have more trading. If you use, for example, very short periods, SME 10 days to 30 days, then you blow up your turnover rate and your cost and your taxes, which doesn't make any sense. If you do it in longer periods, for example, SME 50, 200, then you will be slow and in reacting. So it is very difficult to do so, and we didn't find any evidence that it did add value. So we don't recommend to do it.
Thank you. Any question from the room?
If you have a question, just do it in English, because my Spanish is not that great.
But you can do also in Spanish and we will translate. Yeah. I was not ashamed, so please do it.
What do you think in waiting our also adding to our fundamental analysis, do some strategies, market timing strategies. For example, if I want to buy a year's loser, wait until the end of the year when there's the tax selling, and maybe buy the last months in order to also benefit from January effect. That is statistically the year that offers the best returns.
Yeah, there is the January effect is there, so we cannot deny it. And I know some people, we also try to play a little bit on it. So I think it makes sense. What we also looked at, and that's quite surprisingly, is that if you only look at valuation, that it only works in the long run. So if you try to play market timing, and you say we're just going to buy cheap and we're just going to put our money at work when it's very cheap, that it works, but only in the long run, not in the short run. But you're right, the January effect is there. So we also try to be fully invested before year end, because it just makes sense. Most of the time it is there. And this year it's again the same thing, yeah.
Yeah, I have one question. It's also a tricky one. As you advise us to buy and hold strategies, why we don't buy ETF then?
That's a good question. I was quite surprised also a couple of years ago when Warren Buffett said that it's probably the best thing you can do, and I think he's right about saying that. I was thinking, what is he saying? But it's right, because most people don't know how to invest, because we are all professionals and we know that there are certain factors that do work, like value investing and small cap investing, but most people don't have a clue. So instead of being in cash and not invest your money, I think an ETF is a very good proposal. It's low in fees, and if you stay invested, that's very important, then you will make a decent amount of money. But I think we as professionals, we can do better. We know that active management can deliver you alpha in the long run, and we can play, or we also play on these factors like value, like small caps, like momentum. So there are a number of factors that work. So I don't put my own money into ETFs, but I think it's a great solution for a lot of people. Yeah.
Thanks.
I have a question here from YouTube.
Yeah.
Wim, what do you think about using the advanced decline line of an index to understand the market trend? I think it's a
technical analysis.
Yes.
Well, one study I'm referring to did research on 49 country indices, and they used about 5,000 technical factors, which is amazing. And they didn't find any evidence that they could predict what the stock market in a certain country was going to do. So, as I said, most of these things out of symbol, they can work, but if you put them at work, you're just confronted by the fact that sometimes they don't work, and you're always confronted by the fact that you have these costs and taxes that come into play. You don't have them, of course, when you do these studies. So my answer is more or less the same. Be very careful in doing so, because there has been a number of factors that have been investigated, but we have never found a factor that works all the time.
Any question? So I have one more. So go, please. Sorry.
Hi. If you put the volatility into the equation, do you think you can improve the performance ratio of a portfolio by market timing?
But that's the odd thing about market timing, is that people in playing that, they want to lower drawdowns. That's the first thing they want to do, and they want to lower the volatility. And what we found is that the opposite happens. We see that maximum drawdowns tend even to be higher, and we also found that volatility is a little bit higher, not meaningful, but a little bit higher. In terms of risk return, it's better. So it's worse. So they have a higher risk and they have a lower return. And so that's the odd thing about doing market timing, is that people just want to avoid it, and by doing that they increase the risk into the portfolio. And also you have the opportunity cost. That's a fact why you lower your return, because you're just not participating in the early part of the bull market. And it's also mentioned in the article, the biggest part of the run of a bull market is just in the first 6 months after the decline. So that's the time when most people are just sitting on this pile of cash. And then afterwards, behavioral bias come into play, because you're sitting on this cash, the market is running. Then you have these explanations saying it's just a sucker rally. You know, it will come down again, but it doesn't come down. And I've met people that till the end of 2012 was just saying it's a sucker rally, and then all of a sudden they were giving up, but they missed 3 years of upside markets. So that's quite difficult to do so, yeah.
Thanks.
So I have a question. Looking to the room, I see young people, and as you know, students are watching also. And when you are talking about market timing, you always talk about long-term investment. But is there a time frame where we can say before 10 years, after 10 years, market timing can eventually work?
Market timing can work in very short time periods. For example, if you beginning of 2008, you would have placed everything on a saving account, and by the end of the year, you look at the difference between an equity fund and your saving accounts. I think you would be very glad that you had done that. So there are a number of periods where market timing can deliver you an opportunity, but the main question is always, when do you come back? And the problem, if you're looking over a period of 100 years, we can best look at the S&P 500. Over this period, we have had two very big corrections. That's 29 and 2008. We have had some major corrections like 2001, 2002, but then value stocks rallied, so there was a non-issue. We are talking about the energy crisis beginning of the 70s. But all the rest, the corrections we have seen were corrections of minus 20%, minus 25%. It's not a big deal, you know, it's not pleasant when the market starts to correct, but it's not that you're going to lose your entire wealth. So you would have faced a lot of false trading signals by trying to play on that. So let's be honest, over the last 100 years, it would have paid off twice, but not more. So good luck just to find these two periods where it could have paid off.
So at any age, think long term.
Think long term, definitely. Yeah.
Okay, Wim, here I have another question from YouTube. What's your opinion about using the dollar as an investment strategy which avoids to do market timing? Use the dollar as an investment case.
Just the dollar?
The dollar, yes, investing in the dollar.
Because you have some yield on the dollar, is that the question?
I think.
Well, as I said, the main study I focused on was a study on the South African market where the yield was about between 6 and 8%, because inflation in South Africa is much higher, and they didn't find any evidence that it did pay off. So let's be honest, I think the dollar deserves a place in every diversified investment portfolio, but we didn't find any evidence that market timing works by playing it on the dollar. And most of these pieces of research are just American-based, because we have great American people, academics. So we don't find any evidence that we can do it better in America than for example, in Europe. So, but as I said, the dollar deserves a place in a portfolio, but not to play market timing. Yeah.
Any other question? Yes, please.
Thank you. Do you think that active managers in the American market earn their money, or it's better to invest there by an ETF?
It has been a very difficult market over the last couple of years, and when you look at the number of managers that outperformed, they are very low. I think it's even not 10%. So it does make a case for passive investment. What worries me a bit about these trackers is that definitely when they are capitalization weighted, all the money goes to the same stocks, the FANG stocks. And when I look at valuation, these are great companies, but this cannot continue forever. So that's the reason why we don't do it. I like to prefer to have 2% lower return in an upside market, but to invest into a sound investment philosophy than just to invest into a tracker that delivered me 2% more, but I don't believe in all the stocks in this tracker. So I believe in active management. I know it didn't work over the last couple of years in the States, but I'm sure, and we have seen the same at the end of the 90s when the market turned, then some styles like value, some investment philosophies like value did come back and deliver a great return. So I still continue to believe that we can make a difference there, yeah.
Another questions? From YouTube, maybe? No? So I can continue to have thousands of questions, but if I don't want to monopolize the stage. Anyway, if you have more questions, you can always ask us, and we will put you in contact with Wim. The presentation will be on our website, and I just want to thank you for your coming here. Wim, to come from Brussels just for the event, and I hope that you find the market timing presentation interesting. Thanks a lot. Gracias.